Hello everyone and welcome to this lecture session where I'm going to discuss with you how to determine the deferred tax. The deferred tax is discussed under International Accounting Standard 12, income taxes. On your student account, you're going to be able to find two lecture videos. One is giving an introduction to current taxes and another one is giving a full discussion on deferred taxes. So as I have indicated in the lecture session for deferred tax, I mentioned that we are going to use or support that foregoing discussion with an exam type question. This exam type question, you're going to find it in your notes. I'm trying to get to that page. So this question is on page 115 of the current notes that you have. So we have our brother limited. We were given several things here. Information regarding the company for the year 31st of May 2018. The examiner gave us the carrying amount and the tax basis plus some information here, which I believe we have run through in our previous lecture video. So I will proceed to indicate how you shall be doing this in the exam. So what you do, this is going to be my sheet where I'm going to present my working. So of course you begin by listing out the elements that you have, the elements of financial statements, and then you need to indicate the carrying amounts, and then you also need to indicate the tax basis. Now, the carrying amounts are determined according to the International Accounting Standards, the IFRSs or International Accounting Standards, IASs, and then the tax bases are determined following the tax law. In our case, we are looking at the Income Tax Act, which helps us or governs the determination of tax bases. So, as we mentioned in our discussion, we mentioned that because of the fact that International Accounting Standards and the tax law give various ways of computing the amounts that are supposed to be included in the financial statements, there's going to be a difference created between the two amounts. So the difference, we are going to capture the difference in the third column, and then for explanatory purposes, we shall be giving remarks, reasons why we are treating some of these items the way we shall be treating them in this session. So the remarks are going to be in this other column. So looking at our question, we have the first item, which is property, plant and equipment. According to the question, we are given the carrying value as 200 million and the tax base as 175 million. So I'll begin by recognizing the property, plant and equipment. The carrying value is 200 million, the tax base is 175 million. So the difference created, we shall look at the difference. The difference between the two is 25,000, and we mentioned that the difference is computed as the carrying value minus the tax base. So we mentioned that the difference can either be positive or negative. Positive is where the carrying value is in excess of the tax base, and negative is where the tax base is in excess or greater than the carrying value. So in our case here, in the first element, the difference is positive. So this one is what we said we would say is the temporary taxable temporary difference, the taxable temporary difference. Next on our question, our next item is coming from receivables. So we have trade receivables of 50,000 in carrying value. So I bring the trade receivables, that's the 50,000. Now for the case of the tax base, we are given a note. We are told that in note number 1 that the trade receivables balance in the accounts is made up of the following amounts. We are given the balances, the carrying value, the balance of 55,000, and then we see that the accountant has deducted doubtful debts provision of 5 million, and that gives us the carrying value that is indicated here of 50,000. However, In note C, they are telling us that allowances for doubtful debts was non-deductible for tax purposes, and amounts in respect of receivables are only deductible on application of a court order to a specific amount. So the indication of this is that the tax law does not allow such deductions like doubtful debts on the balances of trade receivables or accounts receivables. So it means that we shall add back the doubtful debts of 5,000 to arrive at the tax base. So in our computation of the tax base, we shall, of course, there is going to be a note here. You didn't. So, like the way we do it in taxation, what we shall do, we shall get the carrying value as reported by the accountant. Of course, the currency I'm using is shillings in thousands. So my shillings are in thousands. So the carrying value is 50 million as indicated by the accountant. And then we add back the disallowables. So the disallowable here is the doubtful debts provision. So the doubtful debts provision is not an allowable deduction, and those of you who have done taxation, you know that. I've been doing it time and again. So when you add back that, we get the tax base, which is 55,000, which is this plus this, and that gives us the 55,000. So this one would be part of the workings that you're going to present to the examiner. Okay, this is part of the workings that you're going to present to the examiner. So my tax base comes to 55,000, and now I look for the difference. 50 minus 55, that gives me negative 5 million. Okay, now because the difference is a negative, we said in our discussion, if the difference is a negative, it creates what we call a deductible temporary difference. It creates what we call a deductible temporary difference. Next, we have the interest receivable. When you look at our elements here given to us, we have interest receivable, and our interest receivable has a note. Of course, the accountant has recognized a figure of 1 million. When you come into the notes, you find that we are saying that note number B here, interest is taxed on a cash basis. Interest is taxed on a cash basis. So the accountant has used accruals basis. He has recognized the interest regardless of whether money has been received or not. But for tax purposes, this is not a realized interest, and it's going to be treated as such. So when it comes to our deferred tax computation schedule, you will recognize the 1 million as per the IFRS's, the carrying value. And then because this is not recognized for tax purposes, and then because interest is recognized on a cash basis, we shall not have a tax base for that element. So that is a 0 or nil for that matter, which gives us a difference of 1 million right there. So because it is positive, it will qualify to be a taxable temporary difference. Qualifies to be a taxable temporary difference. Next, you see in our question that we have a fine. This is now under payables. The payables, we have two elements under payables. We have the fine and interest payable. So the fine has been recorded by the accountant as 10 million. Okay, it has a carrying value of 10 million. So we need to determine the tax base. So I come back to my deferred tax computation schedule. I recognize the fine as 10 million carrying value. But now, fines and penalties are not allowable deductions. In the previous session, if you go through that lecture video, for those who have gone through that lecture video, I've mentioned that fines and penalties are not allowable deductions according to most of the jurisdictions, according to the tax law. And this is the position for all tax jurisdictions. I don't think there is any nation or tax system that allows fines and penalties. These are totally not allowed. So if they are not allowed, then they give rise to what we call a permanent difference. Now, for deferred tax purpose computations, you've mentioned that there is nothing you can do about permanent differences. You cannot provide for them. So it means that there is no value for the difference for such elements that cause permanent differences. So what we do when we are calculating deferred tax, we equate, okay, the tax base and the carrying value so that the difference comes to zero. The tax base and the carrying value are the same, are taken to be the same, so that we don't have any difference there. As I've mentioned, this one leads to what we call a permanent difference. The carrying value is equal to the tax base. So there is no temporary difference for that item. I hope that one is very, very clear. If you have any question, please leave your comment in the comment section below this video. I'll be able to get back to you either through email or instantly if it is through a live interactive session. Next, if you look at our question, we have interest payable. Interest payable, as you know, not part B, interest is taxed on a cash basis. So the accountant, which is the position of most of the international accounting standards, we recognize transactions whether money has been paid or not. That is accruals basis. But in most tax systems or most of the provisions under tax law, you find that you recognize interest, especially those who do the accounting under cash basis. We recognize interest when it has been paid. So in this case, we haven't yet paid this 2 million, and therefore it has no tax base. It won't be recognized under the tax law. So what we do, we bring our interest payable into our computation schedule. It has a carrying value as per the question of 2 million. Now I'm putting this in brackets, or I'm taking it as a negative, because interest payable is different from interest receivable. So to try and distinguish between these two, I need to indicate that this is a liability, whereas this one is an asset. It's positive. Liability is negative, asset is positive. Now this one doesn't have a tax base because of the information given to us that the company is following a cash-based kind of accounting for tax purposes, and therefore interest is only recognized when paid. So that leaves us with a difference of 2 million, and because it is a negative, as a result of this being a liability, it gives rise to what we call a deductible temporary difference. So when I look at the information I have here, we have catered for everything. Maybe for the additional information, this has been done. The allowance, we've talked about it. Okay, then the fines, obviously, as I mentioned, it is agreed, or it is the same position by all tax systems or tax law, that fines and penalties are not deductible for tax purposes. So I find that everything has been treated here. So the next thing we are going to do is to make the analysis for deferred tax. From the information that we have got, we are now going to analyze our deferred tax. So as you analyze deferred tax, what you're going to do, you create again 2 columns just below the deferred tax computation schedule, and I think I should call this one I should give it a title, computation schedule, deferred tax computation schedule, deferred tax computation schedule. So I'm now moving into the next schedule where I'm going to analyze the deferred tax. So we have you create 2 columns. Okay, after working out this, create 2 columns. One column, you capture the temporary difference, okay, depending on the currency. Mine is the shilling. Then you will need to compute the resultant deferred tax, whether it's a liability or asset, at 30%. Okay, so we shall start by picking up the taxable temporary differences. So these are cases where the difference came out as a positive. That is on the property, plant and equipment. We got a 25,000 taxable temporary difference. And then we have the interest payable, which gave us a taxable temporary difference of 1 million. So of course we said that the taxable temporary difference creates what we call a deferred tax liability. It creates what we call a deferred tax liability. So I'm summing up the 25 million plus 1 million, and that is giving me 26 million. Now I want you to go to your calculators and look for 30% of the 26 million. 30% of 26 million. Alright, so you see that 30% of 26 million is 7.8 million. So that is the resultant deferred tax liability. That is the resultant deferred tax liability. Now where do I get the 30%? The 30%, I'm picking it from the question. The examiner is telling us that the corporation tax rate is 30%. Now depending on your tax law, you will use the rate that you have been given. And for exam purposes, the examiner can give you any rate, not only 30%. But I know that most, on average, most tax jurisdictions are charging right now 30% as the corporate tax. So that's where I'm getting my 30%. Now after you're done with the taxable temporary differences, if you have any deductible temporary differences, you now bring them into your computation. So right now I'm going to pick up the deductible temporary differences. Those are cases where the difference is a negative, okay? And this happened under trade receivables, that's a 5 million, and interest payable, and that is our 2 million. Trade receivables and interest payable, and that is our 2 million right there. So I'm going to add up the two, and of course, you know, in our discussion we mentioned that deductible temporary differences give rise to what we call deferred tax assets. They give rise to what we call deferred tax assets. So here we have a deferred tax asset in total of 7 million, and of course I'll compute the deferred tax. I mean, here we have a total temporary difference, total deductible temporary difference of 7 million, okay? Total deductible temporary difference of 7 million, and to get the deferred tax asset I have to subject the 7 million to 30%. So 30%, I want you to get your calculators. Okay, I want you to get your calculators and look for 30% of 7 million. Alright, so you'll find that 30% of our 7 million comes to 2.1. So we are going to offset the deferred tax liability vis-a-vis the deferred tax asset, and you find that our deferred tax provision comes to 5.7 million. Okay, our deferred tax provision is coming to 5.7 million. So it means that in this financial year, Brother Limited has to make a deferred tax provision of 5.7 million. Now, what you know about provisions is that if a provision is done for the very first time, it is the figure that you have got that's going to be taken as an expenditure in profit or loss. But in our case, we have information that deferred tax has already been done in previous years. It's not the first time we are doing it. In note A, we are told that deferred tax balance on 1st of June 2017 was actually 1.2 million, meaning that we have a balance brought forward from the previous year. So with provisions, you need to compare the current provision with the previous provision. If there is an increase in the provision, that becomes an expenditure. If there is a decrease in provision, that becomes income. Now in our case, we need to prepare the deferred tax account, which I have right here. I've already prepared one here, and I'm going to indicate all those facts in this T account. And of course, as you know, this side is the debit, the other side is the credit. So I start by recognizing the opening balance from previous year. So because this is a liability, the opening balance will be on the credit, and that is the 1.2. So right now we have made a provision of 5.7, and that's the balance that's going to be carried forward to the following year, 2019. Now, as you can see, there's a difference between the credit and the debit. Now, the difference is taken to P&L as an expenditure. So try to get your calculator and get the difference here. Of course, I know the debit is bigger, 5.7, and that's going to be the balancing total. Then the balancing figure is the expenditure that is taken to P&L, which is 4.5. So in our question, the examiner, which is always the case, it is always the case, the examiner will require you to compute the deferred tax provision for the year. At the same time, the charge that is going to be taken to profit or loss. So the deferred tax provision for the year is 5.7, and our deferred tax in the statement of financial position or balance sheet for that matter will be reading 5.7 non-current liabilities. Under non-current liabilities, you're going to have your deferred tax of 5.7. I hope you've noted the presentation. The presentation, this is a deferred tax liability, and you must indicate this under the non-current liabilities. Now, at the same time, you're going to recognize an expenditure in your administrative expenses, or whichever classification you can give it. You're going to recognize an expenditure of 4.5 in your statement of profit or loss. So I thank you for taking off your time to go through this session, and I hope you can be able to do all the other numbers on deferred tax. Otherwise, I wish you the best. If you have any question, please leave the comment in the comment section on this video. Thank you.